The broadcast is now starting. All attendees are in listen-only mode.
Well, it's a warm welcome. We're on the 13th of December, and if, like me, 13 is your lucky number, or if you have been investing in the portfolio for the last 3 years, because it's exactly 3 years that we have since we've launched it, well, it's been quite a lucky time as well. We're going to be talking about the portfolio over the last 3 years, trying to see it in some kind of context, and then we'll be going through the individual stocks and, of course, lots of time for questions. But first, my colleague and Biznews's managing editor, Stuart Lowman, is in Johannesburg. Stu?
Thanks, Alec. Always good to be here. Just quickly before we get into things, can the attendees please raise their hands if they can hear my voice and see Alec's first slide of the Biznews Global Share Portfolio? This little virtual hand, if you just click on that, it'll let us know that everyone can see and hear us. There's stuff coming through. Okay, I've got a few hands. That's good. Excellent. We also try to keep the portfolio, the sort of webinar, very interactive. If you've got any questions, please just put them in the control panel on the right-hand side. There's a little questions drop-down menu. Slot those in, and I'll pass them on to Alec as we go through the presentation. We do like to keep it very interactive, though, so please don't hold back on those questions. But Alec, over to you, and happy anniversary, as they say.
Yeah, happy anniversary indeed. Just to make sure that you know that I am here and I am around and coming to you live. You can even see the Zimbabwe bird on the behind me there. That's just a little reminder about what's going on back home, and very good news in the last month of what's been happening in Zimbabwe. Just before we move on to the portfolio itself, I was very interested to see, Stu, that my dear friend Trevor Ngcobe has sold the Mail and Guardian, and the reason for it is he's going back home to Zim, and they're making a big contribution. Now, if I know it's Trevor well, and he's a very sensible, balanced human being, and if he can see the upside of the end of Mugabe, well, then I guess we got to take that as a big tip. Unfortunately, though, we don't have Zimbabwean shares that we can invest in this portfolio. All right, Stuart, we are all good then on the technical side. We can launch, can we?
Yes, all ready to roll. Alec, do you want to pop off with this first question, or do you want to get into the portfolio first?
Yeah, let's. There was a question that somebody sent through that Stuart was talking to me about off air. Maybe it's a good idea for us to go with that, and that could give us a nice basis from which to continue from here.
Thanks, Alec. It was just one of the premium articles done by Jackie Cameron. She spoke about US equities in bubbles of epic proportions and a chart to take note of. I'll put that link into the chat for people to have a read if they want. But he just wants to get your thoughts on this view of the bubble, etc., and the chart itself.
It is something that has to be starting to exercise our minds right now, and certainly does for me. I'll just go into the let's take my pretty face away from the screen and just go into the portfolio, and I want to just show you this portfolio while we're talking about this. This is a portfolio that began 3 years ago. As you can see, our first investments were on the 5th of December 2014. It's grown by 65% in US dollar terms over that period. When you add the South African Rand appreciation, it's more than 100% of your return on your money in 3 years, and the Rand's only up just over 20%. The intention of the portfolio to begin with was that we would give South Africans who were concerned, as we were, about the economic mismanagement of the country, some guidance in how they could invest money offshore. So instead of just throwing it into something that you don't really know, the idea was every month we would be going to these shares, which I personally have invested in. I've invested in the portfolio just like everybody else who's come along for the ride. And by investing in these shares, we would then keep updated, and that would be my job to first of all select the stocks and then to update everybody on those shares. So that's the background to it. You cannot honestly believe that a share portfolio is going to grow at this kind of rate indefinitely. 37% annualized growth rate is what we've achieved in this in the portfolio, and those are mind-blowing figures. That's in South African rands, by the way, not in US dollars. It's a little less, quite a lot less in US dollars. And the reason for this has been we were very lucky in a number of cases, and as we go through the portfolio, we can show you that. But also because we've understood the underlying companies, I think, and then understood why we were investing into those businesses. And when there have been reverses in certain businesses, you will recall, those who've been around for a long time, that we sold IBM, we sold Novo Nordisk, we sold Barclays, because in all three instances, there were fundamental changes to those businesses or to the reasons why we bought into the business in the first place. And then we've also reduced our stake in the ETF, the exchange traded fund in Vanguard, and we've also reduced our stake in Berkshire Hathaway, which, as you can see, is 6% of the portfolio now. It started at 15%. The idea there was that we would, if we found a better investment opportunity than those two bankers, we would put the money into those shares. Generally speaking, the portfolio has performed extremely well, as you can see from the percentage rise in the holdings that we have. And if you look back on it, it's very easy to listen to what Neil Woodford, the fund manager, the very famous UK fund manager, is saying about there being a bubble in international shares. My concern about this is there are a few issues that I have. The one is, if you get the fourth industrial revolution and if you get what exponential companies are, then you have to believe that the extrapolations that you're making into the future for an exponential company is very, very different to that of a business that is growing at best by 5%. Amazon is accelerating its growth, and it's been around for 30 years. Similarly, Alphabet, Apple has had a fantastic run recently. Tencent, well, yesterday there was a presentation in New York by Naspers, whose major shareholding is in Tencent. They own 34% of the company. And the Naspers team continuously look at whether or not the return on investment from the money that they've invested is likely to grow into the future. They don't look at the share prices, they look at the company itself, and they still see Tencent growing exponentially. Similar story can be made for Facebook. Microsoft, which is a mature business in there, in my opinion, because of their move to the cloud, to Office 365, has got the potential to transform that business as well. Metro Bank is a bank in the UK. It's growing at 60% a year. And Tesla, well, we can have a whole hour on Tesla if we want, but Tesla is a bet on, well, if you bet on the iPhone, on Apple and the iPhone in 2007, you would be betting on Tesla and the electric car, and particularly the Model S, as things happen right now. The iPhone completely transformed the cell phone market, and Model S, the electric car of Tesla's, is completely transforming the electric car market. What Tesla is now doing, of course, the big challenge there is whether or not it can deliver on producing the mass market model called the Model 3. But when you look at this portfolio, this is not a typical portfolio that you would invest in and say, oh, the share markets go up, the share markets go down. These companies are perhaps going to have a wobbly or come off tracks. All of the companies in this portfolio have the potential to continue to grow exponentially, with the exception of Vanguard and Berkshire, but I explained that before. They're our bankers. So when you make these broad statements about the market is in a bubble and that the market, in other words, in inverted commas, then you really need to unpack what the guy is saying. And if he's saying that Amazon is overpriced, or Alphabet or Apple or Tencent is overpriced, then you need to look into that company itself and get a very good sense for yourself whether or not, if the stock market was closed for the next 5 years, because that's the way that one must invest, Warren Buffett teaches us, in 5 years' time, is that company going to be more valuable than it is today? And in every instance of these companies, if there was no stock market trading whatsoever in the next 5 years, from where I'm sitting at the moment, I would say that all of them would be more valuable. Are the prices likely to decline in the short term? Indeed. Are we going to continue to grow at 37% compound a year? Well, that would be ridiculous. That would be, it would be fantastic if it happens, But to even suggest that that is going to be, that is likely, is really pushing the limits of any credibility. In the long term, if you can get 7% a year real growth in equities, then you are the best in the world. You're achieving the best in the world. So if you're nervous and you can't sleep at night, then I would suggest what you do is you take money off the table, take a significant portion of your portfolio, put it into cash, and then you just let the rest ride, if that's the thing that worries you. If this is a portfolio that you're very comfortable to close your eyes to for the next 5 years, and if there are bumps along the way, just live with them. Because in 5 years' time, if you look at the growth of these companies, then in 5 years' time, they're likely to be worth more. Whether there's a bubble of the NASDAQ proportions of the year 2000 or a bubble of Bitcoin of the year 2017, December, it just doesn't look like it from every angle that I look at. It doesn't mean that there can't be a correction, but to start calling bubbles and start calling the top of markets is a very, very dangerous business. And I think as we go through the portfolio, we'll get a better sense of that. Just to give you that, the portfolio in rands, we started off, by the way, in the US with $200,000. That was the whole idea. December 2014, $200,000 was invested. That's now $330,000. In the last month, incidentally, the portfolio is down by $1,000. So it gives you an indication that it's pretty stable where it is at the moment. From a rand perspective, we started with 2.14 million rand. Remember, it was $200,000. You could multiply it by, I think it was 1170 at the time. And here is the rand value today is at 4.5 million. So put in just over 2 million, you're now looking at 4.5 million. You've done fantastically well. If you're nervous about it, well, sell half your portfolio, put that money in the bank. You can lose nothing, and then let the rest ride. If you're nervous of where I'm sitting at right now, I would leave the funds to run for the next 5 years, whether Neil Woodford thinks it's a good idea or not. The problem that one has with any of these things when you're investing is that you just don't know about timing. And this graph that we have on the screen of the rand's performance, remember, this was a portfolio that we created based on the fact that we felt the rand would be weaker in the long term because of the mismanagement of the economy. That's the fundamental basis. What has happened, as you can see, it was a correct view between 2015 and 2016. And then from 2016 to 2017, when the mismanagement of the economy actually got into, well, it tempered somewhat, because you might recall, in fact, today, it's exactly 2 years today since Pravin Gordhan took over again as Finance Minister of South Africa. And when Pravin Gordhan came back in, which was in December 2015, after 30th of December 2015, after Nenegate, we had that spike in the rand going the wrong way after Nenegate. And then through his efforts and through the belief in the international community that South Africa would start adopting more sensible economic policies, you can see what happened between 2016 and 2017, and that was the rand appreciating from over 16 to the US dollar to around 13 at one point to the US dollar. And then you can see, again, just go a little bit further on that graph. It's very, very clear. Follow it all the way down, and you get to around the 31st of March, or 1/3 into 2017. And what happens? Whoops, the rand starts going the other way. It takes a spike to begin with. That was when Pravin Gordhan was unshuffled out of the cabinet. And as you can see, the rand bounced around for a while at higher levels and depreciated and is now around about the 14 level. What does all of this mean for the immediate future? We don't know who's going to win after the ANC elective conference, which starts in 3 days. We've got no idea. But if Cyril Ramaphosa wins, you will probably have the Gordhan effect, because Cyril Ramaphosa is someone who understands economics. He is likely to have the same kind of impact as Pravin Gordhan had between 2016 and 2017. Indeed, it's likely that he would reinstate Pravin Gordhan, give the international community the reason to invest in South Africa, and this country desperately needs foreign investment capital to create jobs. If, however, the pollsters are wrong and that the numbers that we've seen from the branches are incorrect, and Cyril Ramaphosa does not win for whatever reason, then we are likely to see a continuation of what we've seen with the rand since the departure of Pravin Gordhan. And that's a very clear signal that you can see running up to when he was appointed in between 2015 and 2016, and what happened between the first quarter 2017 and where we are right now in the rand. I think it's about as clear as you can see. But within all of that, you could, if you were trying to time your purchases this way or the other way, you could have got it wrong. And that's really what it's about. If you can get the big trends right, if you can just make sure that you understand why it is that you're investing in a certain portfolio. My sense would be that we would need to reassess everything on an offshore portfolio should Cyril Ramaphosa win in December. But I'm not going to say to you now that we need to liquidate this portfolio or sell everything in anticipation of that. So it's too high a risk to do that. But if Cyril were to win in the next few days, when the ANC gets together, and anybody who is economically savvy will be praying for that result. If that were to be the situation, then you would have to reassess, because this whole portfolio for the last 3 years has been based on the premise that the economy would be poorly managed. Under Ramaphosa, it's likely that the economy will be better managed, much better managed, and as a consequence of that, the rand's weakness, which is the underlying reason why you have invested in this portfolio, could actually be reversed. So it's a watershed period for the ANC, it's a watershed for the country, and we need to be very mindful and very aware of that. That's on the one side. Then on the other side, of course, are the stocks that we've invested in artificially high? Well, look at these individual performances in 3 years. Remember, we've got Amazon. Well, there's the rand, incidentally. In 3 years, the rand has depreciated by 21%. So the underlying view that we needed to get a hedge against the rand was accurate. Where we've been incredibly fortunate is that, first of all, we invested in the United States, which has been the best performing market of the big markets. Secondly, that we were very fortunate to get some stocks that have performed incredibly well, primarily Amazon.com. As you can see there, when we bought the shares, they were called 3,700 Rand each. They're now 16,000 Rand each, a gain of 341%. Does that mean that Amazon's going to fall in a heap? Probably not, because Amazon's story is only now being understood. What Amazon is making money, a lot of money out of, is Amazon Web Services, and the rest of the money is being re-injected into its distribution model, which literally is taking over industries. I've said this before, if you live in the UK as we do at the moment, you can see the Amazon effect. And the Amazon effect is enormous in that you literally go online to buy anything from a marker for a whiteboard through to a technology equipment, a computer, and it gets delivered to your home, through to bookcases, which my famous story of bookcases that took 3 months for the first one to arrive. I'm still waiting for the next one. So the bookcases are not a problem, or not something that Amazon's really good at, but anything that's small and easily deliverable to a house, there it is. And Amazon has just gone into China. This month, it announced that it's going to be operating Amazon Web Services in China, and that is a huge opportunity for the company to continue on its very rapid growth spurt. There's still a lot of road left. You only have to look at high streets and see how many shops there are in retail outlets in high streets to know that Amazon has got a long way to grow before it starts getting saturated. So is it going to go X growth anytime soon? I don't believe so. But we have to be mindful that it's had a fantastic run. So putting all of that together, where are you in this portfolio at the moment? Well, you've got some stocks that have performed incredibly well, and you have a rand which has weakened in the way that you thought it would. From here, depending on what happens at the ANC conference, the rand could become a different determinant. You could have these companies' share prices as a consequence, just an immediate thing there. If the rand were to go back to 11 rand 27, clearly that would have an immediate 20% smack on all of these share prices, which would bring those returns down quite significantly. But if you have a look at Vanguard S&P 500, the one halfway through with a 52% growth rate, that has been the US stock market. So the rand's depreciated 21%, but it's our benefit has been double on that, because we've had the Vanguard S&P 500 index. We've been betting on American share market, and that's the base level there. Stuart, I hope that answers it. I know it's a long way of addressing a question like that, but I thought it was a good way to kind of kick things off.
No, thanks, Alec. I think it's important to separate the bottom up and the top down approach, and this very bottom up. So you've got to be aware of what's out in the media, in terms of investing. So very, very nicely done. Alec, there's a question on Naspers. I know it's not in this portfolio, but I do know you referred to it in your newsletter this morning. Benjamin just wants to know if it's a buy now. I think it's off the back of that comment from Bob van Dijk last night.
Well, I spent quite a bit of time listening to Bob. I listened to his whole presentation and to the questions and answers, and I really thought he did very well. I also intend listening to the rest of the presentations, because there have been reports, and it's on Biznews in Premium, that Naspers is looking aggressively to start an ADR program. Let me just put it into perspective. Naspers owns 34% of Tencent. Tencent is a gigantic company. It's the operating system for 900 million Chinese. When they get their cell phones, when they switch it on, the first thing they see is Tencent. They don't see Apple. They don't see Samsung. The operating system goes through apps. That's how strong Tencent is in that market. Naspers is really a proxy for Tencent. We have Tencent in this portfolio because I'm extremely enamored with the opportunity and the potential of Tencent. And as you can see, even from this little graph, we didn't buy Tencent that long ago. It's already given us nearly 42, or there's a better one. It's given us a 42% return. We bought it for 500 Rand a share. It's now 720 Rand a share if you convert it into Rand terms. It's been a smashing performer. So if Naspers is a proxy for Tencent, what do I mean? Well, if you were to take the Tencent shares that are owned by Naspers, and if you then distributed them to Naspers shareholders, so forget about the rest of it, forget about Mail.ru, forget about Flipkart, forget about Delivery Hero, some very good businesses that Naspers has got there, and it's bringing to profitability, and these are billion-dollar businesses that I've just mentioned. If you just took Tencent, you would then have a 30%, 33% uplift on the Naspers share price today, if you just gave everybody in Naspers 10-cent share prices, as 10-cent shares. So when you buy a Naspers share, you're getting, in essence, because you add everything else together, you're getting a 38% discount on the underlying value of Naspers. If you stopped the company today and distributed everything that it had to shareholders, they would get 38% more than what they have at this moment. So that's the value. Is that the question with Naspers is 38% the right number, or of a discount, or should there be a discount at all? Well, Bob van Dijk made the point yesterday that because of liquidity and it's not that easy for foreigners to get in and out of shares, and because Naspers is listed in South Africa, and they're a bit worried that there could be political risk, political turmoil, etc., there needs to be a discount. And traditionally, Naspers has been running at a discount of between 20 and 25%. Now it's at 38. Why has it gone to 38? Van Dijk says the reason for that is because he put it down to 20 months ago, and in the last 20 months, he says the political turbulence in South Africa has frightened foreign investors to the degree that they have sold shares in the South African market indiscriminately. Even though Naspers' share or its profits from South Africa is a fraction. It's nothing. If you think about a 1.5 trillion Rand company, what MultiChoice and News24 and the rest of them make hardly register in that context, because Tencent is just so dominant. But despite the fact that it was a proxy for Tencent, so nervous are international investors about what's going on in South Africa right now that they sell the whole market. Now, Naspers is 20% of the all-share index of the JSE. So if you're selling index funds in South Africa, it means if you sell 1 rand of index funds, you've got to sell 20 cents of Naspers. What the management is trying to do to offset this is the obvious thing. Find another way for investors to invest in this company. You can't take the listing away, and neither does Naspers want to take it from South Africa and go and make a primary listing somewhere else. We saw what happened with Steinhoff. My heavens, it would take a very brave man or woman to make that call right now. But what they can do is they can launch ADRs, or American Depository Receipts. And it can be a very liquid and a very good market in ADRs. And what that means is that if you can buy the shares, American investors can buy the shares in America. So put all of that together. What Bob van Dijk and his team are saying is there's a massive discount between our stock and Tencent. We would like to close that discount, all other things being equal. In other words, if Tencent's share price doesn't move, closing that discount would see the Naspers share price rising. And how they intend doing that is by making it more appealing for international investors to invest in Naspers. Van Dijk said that the loss of money from South Africa in the last 20 months from foreign investors in shares, in equities, has been between 15 and 20 billion dollars. Now, just take 20% of that, which would be $3 to $5 billion. If that were to be put into Naspers shares, because that's what Naspers would have lost from investors, you can imagine what the impact would be. So when we invest in companies, we don't just performing. Tencent's share of the Chinese market is 54%. So of people who are online, 54% of them in China have well, the way they actually described it yesterday was per internet hour. So if you took all the hours that people spent in the country on the internet, in China, 54% of that time was spent on Tencent. So more than half of the time they spend online. The only comparison that Van Dijk was able to give us was Facebook in the United States, where 19% of the time is spent with Facebook. Now, remembering that China has 3 times more people online than the Americans do. China's got a population of 1.6 billion. America's got about 400 million. So that makes a lot of sense. It gives you an understanding that if Tencent were an American company or operating in the American market, it would have 1/3 the market number, and if it were a Facebook, it would have under a half of what its market share is. So when you start getting that as an understanding, something else that he mentioned, which I thought was very exciting, in the United States, around 10% of the population buys online. In China, it's 20%. So it's a bigger market. Tencent has a bigger share of that market, and there are people who are more or keener to use the internet to transact, which is where companies like Tencent make their money. You've got to know that we're onto a winner there, and you've got to know that Naspers is onto a winner as well. So hopefully that gives you as much confidence about the company as I have. However, our big winner is this baby, Amazon.com. That's Jeff Bezos. And what I've done for this special edition, if you like, it's 3 years since we began the portfolio, is to give you a 5-year chart and to show you when it was that we bought into the stock and how the stock has done since then, and whether or not we should be considering lightening the holding or actually selling it. And the big green arrow on this is showing you exactly where the purchase was made. And as you can see, it was after a period. There's a 5-year chart. I've done this with all of them. This is after a period of a couple of years that Amazon had bounced around, not doing a whole lot. It had got to a price of, there you can see, around $400 in 2014. When we bought in, it had come back from that level, and it didn't do much for about a month or two. And then after the quarterly results for the last quarter of 2014 came out, Amazon started moving in the right direction. It's had a few bumps along the road, but we were very lucky in our timing and very lucky in the period that we bought the share. And in fact, if you like, when we started this portfolio, because it didn't take very long for Amazon to start moving. So we had the perfect storm in this respect. Just one last thing there. Some traders would be considering at this point selling out and taking profits, if you like, on their portfolio. Well, it's not something that we would consider, and certainly isn't something that we would be looking at, because the best thing that you can do when you find a great share or a great investment is actually to continue running in that investment, to stay in that investment. And that was something that Koos Bekker has done with Tencent, as far as Naspers is concerned. And we need to learn our lesson from that. All along the way in the last 20 years, Naspers or some activist shareholders have been saying to Naspers, sell the shares, sell our holdings in Tencent. And the brilliance, perhaps, of Naspers is their ability to have resisted that. And the reason they were able to resist that is their shareholding structure is such that it is controlled in the same way that Google or Alphabet is controlled, the same way that Facebook is controlled, by a pyramid company, if you like, at the top of the shareholding, and they are not open to a hostile takeover bid. So that's an interesting point that has been to the benefit of many of these companies that we have in the portfolio. And the idea here with Amazon is you just continue to ride your winners. Alphabet, those co-founders of Alphabet, Larry Page in front and Sergey Brin behind, is an interesting story for us as well. As you can see there, we bought in towards the end of 2015, and the share price didn't do anything for 6 months. And suddenly, when Ruth Porritt was appointed as financial director, she changed the way they thought about a lot of things. And when she came out with the quarterly results halfway through 2015, it was for the second quarter of 2015, suddenly there appeared, at least to the investment community, that there was somebody on board who would be able to cut back on unnecessary wastage or expenditure. And that's what's given them such a strong ride since then. So it's very clear. You look about, it took us, well, about 6 months of holding this and not seeing any improvement until that point happened. And since then, Alphabet, or I suppose what you would call primarily Google, has been a fabulous performer. Next up is Apple. Now, Apple's a company that in 2007 was completely rejuvenated through the invention of Steve Jobs' iPhone, very famous iPhone, which changed the world. It's definitely was the best invention that there was in the first 10 years of the new century. But when you have a look at this share price, I watched Apple for a long time, and in December 2015, when we launched this portfolio, we did not put Apple into it. At the time, it looked like Apple was expensive. And if you look at the other two shares, just quickly looking back at Alphabet, it hadn't done much for a year. Similarly, Amazon hadn't done much for a year either. But by contrast, when you look at that Apple share price, you'll see in the last year, in 2014 to 2015, when end of 2014, when we launched, it had run very strongly. So it pretty much doubled in that year. And that was a mistake. I should have made the investment at that time. I kept watching and kept watching and kept watching. And then, of course, the investment was made in Apple eventually in June 2015. And as you can see, this was a sweat one, hard and white knuckle time, because all the way from June 2015 until late in 2016, so more than a year, this share had underperformed against, well, you could have bought it for cheaper than what we acquired it for in the portfolio. What we do in buying shares in this portfolio is we buy them every 3 months. So if, for instance, with Apple, we started buying them in June, July, August, and of course, by the time we'd finished our purchases, then the share price started falling down. Well, the intention was always to spread it over 3 months so that you take out the impact of the exchange rate, the rand, which can be very volatile, and you take out the impact of a share price movement. We're trying not to get involved in share prices movements at all. We're buying the company. But again, if there's ever an argument for doing your homework, understanding what you're investing in, and being patient, Apple has to be it. You see that we came in there 135, 140, around about that level, and it went down to as low as $90. So at one point, we could have looked back at this and said, my goodness, we are losing our boots. Let's cut our losses. Had we done so, then Apple wouldn't be such a good performer in the portfolio as it is today. And it's one never knows when the market's going to catch up to the underlying fundamentals. Our next biggest holding already is Tencent, and we only bought it fairly recently, as you can see there. This is a 5-year graph, again, a 5-year share price graph. And if you go along to when we bought, it was at a time, again, I've been watching Tencent very carefully. And for a period of time, earlier this year, Tencent bounced around for a period, around about where we bought in May. And you can see it stabilized there. We were very lucky with this one too. Very soon after we bought it, suddenly it started taking off. So in our first 2 months that we acquired our shareholding here, the share price was very attractive, and then it was already rising when we bought in at the 3rd month. But Tencent has been a fabulous performer for us, and I'm expecting it to continue into the future. Facebook, there's another interesting situation. Again, buying at a time where eventually, after watching it for a long time, and as you know, I had my first internet company more than 20 years ago. So this is a field that I understand probably better than any other field from my own personal perspective. And I can see the value and the potency of Facebook as a business, as a social media platform. It just seemed too expensive. So as a consequence, the buying decision was postponed and postponed, and eventually it couldn't be postponed anymore. And of course, just after we bought it, the share price fell, and you can see that what happened after, where that green arrow is. However, again, patience, holding on to it, and Facebook has certainly not disappointed. This is the Vanguard S&P 500 index. This is the index tracker. We started off by having a third of the portfolio in this stock, and sorry, 15% of the portfolio in the stock. We had another 15% in Berkshire, so it was a third together in, if you like, the bankers. We have slowly reduced this as we've gone along, but this gives you an understanding of the way that the US stock market has performed, because the Vanguard S&P 500 index follows. It tracks the US stock market exactly. It tracks the S&P 500 index. And there again, when we began the portfolio in 2014, it did nothing. In fact, it went down. If you go back to 2016, it was the all-share index in the US was trading lower than where it began 2015. It took halfway through 2016 to start breaking into the green, and then you can see towards the end when Donald Trump was elected as US president, and all the promises that he's made, investors love it. Well, they certainly loved him more than they would have loved Hillary Clinton, with all the warts that Trump brings. And you can see how the share price has, how the price of the ETF, the Vanguard 500 S&P 500 ETF, has performed. And just a little aside, the charge on this is 5 bips. That is 1/20th of 1%. Is what the fee is if you buy into the Vanguard 500. It's one of those benefits of scale. Microsoft is a fairly recent acquisition. Again, there was a lot of good fortune here. We like the story of Microsoft and its move towards Office 365. It's a fairly recent decision that they've done. The share price, it's a mature company. It's got a fantastic product, a fantastic platform. It's been able to re-engineer itself when it needed to. But the time that we bought, it had been stabilizing for a period of time. And what really attracted us to this one was the change in its business model to Office 365. And what that is instead of going and buying your Office product, your Microsoft Excel, Word, etc., every year, in this way you have a recurring monthly cost or a recurring annual cost, and then you just get the updates as they come through. So in your new software, it moves Microsoft from an old model to an automated model, and that is a very, very powerful business model, and one that it appears as though investors are now starting to get their heads around. It's a picture of myself with the founder of Metro Bank, Vernon Hill. I guess one has to be careful about these charismatic leaders, as we well know. But Vernon Hill has done it once before. He built Commerce Bank in the United States from nothing to more than 500 branches, sold it for billions, went on leave for a week, and then came back and started Metro Bank in the UK. And he thinks that Metro Bank is even more of an opportunity than the one that the bank that he started in America. You can see that it hasn't done much though, but I wouldn't worry about this. As our track record shows, often we're a little early to these investments. And as you can see, this very shortly after we bought into Metro Bank, the share price fell. But subsequent to that, it's a little better, little higher, but it hasn't been a great performer yet. But it is one of those that it's a company that is underlying business is growing 60% a year. And at some point in time, the market will be able to appreciate or give it its just a due reward. Where the fight is going on as far as Metro Bank is concerned is that some investors are saying with this rapid rate of growth, they're going to need to raise more capital. And as they raise more capital, they're going to sell more shares. So we'll rather just keep the share price or not buy the shares until they offer us more shares at a reasonable price. That is part of the strategy that one would see from the City of London. But it'll be interesting to see how that works out. Vernon Hill, the chairman, when I put this to him, said, well, you just don't, you've been in London too long. You just don't understand how business really works. So let's see. Berkshire Hathaway has had a fantastic month. In fact, it was the best performer just behind Tesla, second best performer of all of our shares this month. The overall portfolio this month was down by $1,000. The moves were Amazon down $1,500, Alphabet $1,000, Apple $500, Tencent down $1,500, Facebook down $1,000. And then on the plus side, Vanguard up $500, Microsoft up $500, Metro up $500, and Berkshire up $1,500. So it balanced the books for us quite nicely. And that's unusual because Berkshire being a very strong holding and Warren Buffett has invested in good old-fashioned businesses. Of course, he did make a huge investment into Apple, and that has helped him as well. He also has big shareholdings in banks, big US banks. So that would also have been lifted by the better outlook for the banks. But anyway, Berkshire had a particularly good month. And then, but you can see again, look at where we bought it. And December 2015, Berkshire was underperforming for a long, long time. Now in 2015 to 2016, that was a period when we had the rand that was appreciating as well, because Pravin Gordhan was in the hot seat at the finance ministry, as mentioned earlier. So we're very fortunate that we had some of the stocks that were performing extremely well in that year, and then other stocks like this one that were underperforming. And if you lost patience with them, you'd be very sorry. And then finally, Tesla. What a story Tesla is. We watched this one for a long time, again, for obvious reasons. Tesla is run by a South African, South African born and raised, Elon Musk, still speaks like us. He is an absolute polymath, a genius who began a number of companies that are transforming industries. SpaceX is a company that we hear a lot about when you look at the whole space story. Musk wants to get humans into Mars or onto Mars, and that's one of the things that motivated him from day one. SpaceX has been a phenomenal story. In fact, if you read the biography of Musk, you'll see that his first 3 rockets of SpaceX failed, and his 4th rocket, had it failed, we probably never have heard of him. Tesla would never be with us because he would have been bankrupted. Yet that one succeeded. And what he's able to do is disrupt the whole space technology, the whole space travel sector. And he has been able to take on with SpaceX business opportunities, launching satellites, etc., from the major corporations and, of course, NASA. And that has made SpaceX into a very, very exciting company. But the one that we're looking at here is Tesla. I mentioned SpaceX because there's quite a lot of rumors doing the round that SpaceX might be merged into Tesla, which could be transformative for this company as well. But that's just rumors, so put that on the back end. Elon Musk owns both companies. Tesla is the one that is listed on the stock market. And again, here, we've after watching it for a long time, had the good fortune of buying it at the time that we did, which was in late 2016, because at that time, there was a merger between Tesla and the third Musk company called SolarCity. Now, SolarCity is a company that he funded that was run or is run by his cousins who grew up with him in Pretoria, the Reeve brothers. In fact, Reeve is the surname of Elon Musk's mother's sister, so his aunt. His name is Elon Reeve Musk. So you can appreciate that the families are very close. So when this merger was done, there was a lot of antagonism on Wall Street about it not making any sense. For Elon Musk, it made all the sense in the world because, first of all, he'd funded the business, and secondly, it was his family who were in the other side. They holiday together. They're very close to each other, the Reeves and the Musks. And he then felt that the business rationale for the merger was that SolarCity, which is the biggest installer of solar-powered panels in the United States. Just think for a minute how big that is. But that's their business. They put solar panels into people's houses, claim back from selling the electricity into the grid, enjoy the subsidies that the government gives them. It's a phenomenal business model. But the most important thing for SolarCity into the future is batteries. And the most important thing for Tesla into the future with electric cars is batteries. So as far as Elon Musk saw it, it was quite simple. Both companies had a huge incentive in producing great batteries or storages of energy. And it seemed much sensible to him that they should be working together on it. Tesla, by the way, in the merger of the two was 93% of the value and SolarCity only 7%. But Wall Street got in a tiz. They issued some sell signals on sell recommendations on Tesla. And we saw that as a great opportunity. And as you can see, we finally bought into the company after watching it for a long time in late 2017 and bought it over a 3-month period as it was falling. And again, the timing was excellent. The Tesla has surged since then. Why has it surged? Is it worth where it is at the moment? Well, remember that story about the Apple iPhone 2007 that was introduced? Up until that point, what did we have? We had the old Nokia dumb phones and Blackberries. Apple came in at a huge premium price. I think the Nokia phones were around $200. Apple came in at $700 to start with, and people just went mad for apples because it was such an improvement on what was existing. That's the classic disruption. You don't have to always disrupt by coming cheap. Tesla did exactly the same thing. There are parallels between what Apple did in 2007 and what Tesla did with its Model S. Model S was the first electric car that people could drive as they had any other as an internal combustion engine car. He sparked a revolution in electric cars, and although Model S costs about $100,000, there are enough of them on the road to see how exciting it is as a vehicle for people who wanted to move away from internal combustion engines. Of course, things have come a long, long way since the first Model S was produced. Even so, today, there's still 95% of the cars on the road are internal combustion engines. In other words, petrol or diesel engines. Elon Musk is wanting to change that, and he's trying to change that with something called the Model 3. And this is where all the controversy comes in, because Musk says we'll produce hundreds of thousands of these Model 3s, and we'll sell them at $35,000 each. The market, again, is what happened at the time that we were first investing in the company. Not everyone in the market believes him. There's lots of skeptics. I went to a presentation with the Schroders guys about a month ago, and they were outspoken on why Tesla was not going to succeed. Their belief was that, buy the car by all means, but don't ever buy the shares. It's massively overpriced, in their opinion. The story here, though, is can Elon Musk deliver? Can he deliver the cars, the hundreds of thousands of Model 3 cars, given that he's not a manufacturer, given that he's an inventor, and he can manufacture high-end, everyone knows the Model S, but can he do this mass production, almost like a Model T Ford kind of transformation for the motor vehicle industry? Well, nobody initially, as you can see, everyone got terribly excited about it, and then more recently the share price has been bumping around a little bit. It came down from 350, got down to 300, went to the late twos for a period of time, but the major reason for that was when the quarterly results came out, and you can see that dip, very recent dip in the share price that came when the quarterly results came out, and it showed that instead of producing thousands, in the third quarter of the year, production issues meant they only produced 260 Model 3s. So remember, this is a car that should be producing hundreds of thousands, but they only managed to get 260 off the production lines. So they don't like it. The investors don't like it. Elon Musk is going to bomb. He's doing it wrong, etc., etc. And yet you see that uptick the last little while. And in fact, last night, the share price, as you can see, was up by nearly 4%. What's going on? Well, the latest stuff that's coming out of Tesla is that they have managed to sort out their production issues. They are looking good for producing 5,000 vehicles per week from the beginning of next year, and they've been doing that since the end of November. So that's the story. Somebody somewhere has gone along and had a look at the output. There's been no announcement from the company. We'll only get that early in the new year with the quarterly results. But someone's gone along there, and the word has spread like wildfire. There are 400,000 of these Model 3s on order. At the rate of 5,000 a week, you're talking about 250,000 production per annum. And my view on this is very simple. Are you prepared to take a bet on human ingenuity? If you do, then you believe the exponential story. And if you do, then you believe the Tesla story. If you are not prepared to take a bet on human ingenuity, if you are going with the naysayers who say that Musk will never be able to turn from producing a limited run of cars to mass production, the view is, well, yeah, sure, he's a clever guy and he's a good inventor, etc. But there's something more that's needed to be a mass producer of motor vehicles. Well, that's what their story is, and that's why this is one of the biggest short positions in the United States is in this stock, because those who don't believe that he's going to get it right think that the company is going to crash and burn. So that's the choice you're making. The view I'm coming from on this one, is we've bought in at a very good price. It can reverse, the stock price can come back a long way. We're running on if you like, on profits on this, and if he gets it right, then $400 is a possibility for this share price. So that's the Elon Musk story. It's a very good, going to be a very interesting set of quarterly results that when they come out in January, because that will tell us whether all these Model 3s that are being seen in parking lots and in distribution centers of the Tesla group, all these Model 3s reflect that they're overcoming their production issues. And if they have, well, the sky on this stock, I suppose, is the limit. So that's the story of the portfolio, Stuart. I've given you quite a lot of a run through there, but it is an anniversary, so I'm glad I had that opportunity.
No, thanks a lot, Alec. It's always good to see progress. Just quickly, there's a few queries on stocks that aren't in the portfolio. I'm not sure if you've got any, short comment on them. It's from Johan and Benjamin. Johan wants to know about Alibaba, Oracle, and then Benjamin talks about marijuana medical shares. I'm not sure if you have any thoughts on those three.
Yeah, Alibaba, we're back to it again. Alibaba is the one I missed. It is a stock that I've missed. We should have, with hindsight, have bought at the same time as Tencent, and it is one that I'm still looking at. Hopefully, there'll be some kind of a dip there, which will give us a good value proposition or a better value proposition. But as you've seen from my record, I tend to either wait too long or buy too early. In this case, it's on the watch list. If you've already got the shares, I certainly wouldn't be selling them. Interesting. Alibaba was a little like Facebook. When Facebook came to market, it came with a huge hype. Share price was strong, and then it got smashed as people didn't believe the story anymore. And that was the time to have bought Facebook shares. And Alibaba was the same thing. When it listed on the New York Stock Exchange, it came on with huge hype, then fell like a stone. And of course, that would have been the time to buy with hindsight. Oracle is one that often gets brought up by investment analysts. It's one that I don't know anything about the company, and thank you for reminding me. I will need to be doing some more homework on it, but it's outside my circle of competence, so no comment on that one. And then the final one on marijuana shares. It's now you talk about Oracle being outside my circle of competence. The Mary Jane producers is like in a different planet for me. So sorry, I really can't even start to hazard any kind of suggestions on that.
Excellent. Thanks, Alec. There's a question from Pierre on Moody's. Obviously, Moody's is the only one of the three rating agencies who hasn't junked South African debt. He just wants to know if you know when the announcement is due and the impact it might have on the portfolio, given the media concerns of the $100 billion sell-off, if we do get junked.
It's a very good question, and it's anticipated early in the new year. Moody's, of the three ratings agencies, has been the one that probably knows South Africa best. It's the one that has been giving South Africa the benefit of the doubt, because it knows what's at stake here, and it hasn't jumped to any conclusion. The elective conference in the next, which starts in 3 days' time, is a watershed for this country, and Moody's knows that, and it's paying attention to it. If the elective conference is to have the kind of result that would see sensible economic policies being implemented here, you can probably see Moody's continuing to give South Africa the benefit of the doubt and retaining the rating where it is, and not having that big sell-off, and not seeing a decline in interest rates and all the horrible knock-on effects that would come from it. And the reason for that simply is that there would be hope that the economy would be able to move towards a position where it could start fulfilling its potential. It's not that this is going to be fixed quickly. We've had a dreadful 10 years, dreadful. Economic mismanagement in this country, fueled by the politics of hate and fear, have really caused damage that is going to take a long time to fix. But ratings agencies look around the world, and it's all a relative game. No other country in the world is perfect. I mean, the Americans have got Donald Trump. UK's got Brexit. The Europeans have got a social welfare system that's unsustainable. Overlay that demographics and immigration. China's got its own issues. Russia, well, Brazil, wherever you look, there are relative issues that are affecting those countries. But the bright spots are relatively few and far between, Argentina being one of them, with Macron in France being another of them. And South Africa under a Ramaphosa regime could be another one of them as well. So that's where Moody's is thinking about. The other two have already made up their mind. There have been lots of discussions here in London about the fact that those who think Ramaphosa is going to be elected are actually living on cloud cuckoo land, that it's a done deal, that the election's been bought and paid for long ago, and that it's going to be a continuation of the Zuma legacy. And perhaps some of that talk has permeated through to the perceptions that have been created, because South Africa's institutions have been steadfast. Many of the institutions have been steadfast in this whole state capture story that is now well appreciated around the world. But the view of some people is that it's going to have been a forlorn hope. So Moody's is taking a more optimistic view, and I think for the sake of us all, let's hope that Moody's is the one that's right.
Thanks, Alec. Chris just wants to know, can you please display the dollar portfolio again, so not the rand one?
Pleasure, Chris. We'll go back to that. There we go.
Cool.
Here's the dollar portfolio. Lovely to have 50 Amazon shares, isn't it? Have a look at that number where you started off with, well, $16,000, and it's now worth $58,000. Just to buy one Amazon share today and that's the other thing that often people kind of get this wrong. They think you've got to buy in blocks of 100. That's archaic. You can buy a single share on many online platforms. I had a guy emailing me today, giving me very grumpy about it, saying, Naspers' first thing that they need to do is to have a 100-for-1 share split. And you just think, but why? You can have a 3,500 Rand share. And in fact, if you buy it through Easy Equities, for instance, you can put in 50 Rand and get a fraction of that share. So there's all different ways of owning shares nowadays, but it is still nice to be owning 50 of those Amazons, isn't it?
Thanks, Alec. The questions have been cleared, so I think it's time to say goodbye. It's our last webinar of the year, unfortunately.
It is, and a very, very Merry Christmas to everybody, and a wonderful 2018. If you are of the Jewish religion, or in fact Chinese faith, then you know that 18 is a very lucky number. So, and for our Jewish friends, Happy Hanukkah. May it be a amazing 2018, and may it all start in a few days where hope is rekindled for our country. But even if it goes the other way, in other words, even if Zuma does a grace on us, and or as Mugabe tried to do a grace on Zimbabwe, and that didn't work, but if that happens and his ex-wife, becomes the next president and perpetuates the Venezuela-type policies that are being proposed, all is not lost. There is very, very likely to be a split in the ANC if that were to occur, and then in 2019, almost certainly a change in government. So there's a lot at play. The next few days are a watershed for South Africa. I'm hoping that we all get an early Christmas present, courtesy of the ANC elective conference. And I'm saying that as somebody who understands from economic history that there are certain laws of economics that cannot be broken. Those laws are the type that will be were injected into South Africa by Nelson Mandela and Thabo Mbeki. Those laws were forgotten for the last 10 years. If they are to be reinstated by Mandela's favorite, Cyril Ramaphosa, then everything else will flow from it. And I think we'll all be enjoying our Christmas chicken a little more than in the past. But thank you for supporting Biznews over the past time, for doing the right thing by supporting us with Biznews Premium. You know that the media industry is in a place where new business models are having to be designed. Our business model that we believe in is one where the users pay rather than necessarily the advertisers keep the business going. And that means what we've tried to do with Biznews Premium is keep the cost as low as possible. We've got some very exciting news, which we will be announcing as soon as the contracts are all signed for Biznews Premium, which is going to massively enhance the value of your existing subscription. So hopefully that can be our Christmas present to you. But all round, we're here to serve our community, and we are absolutely delighted in the fact that you are supporting us as well in the way that you are. So thank you. We look forward to catching up again in the new year, and from myself here in London, and of course Stuart.
Yes, thanks a lot, Alec, and happy holidays to everyone listening.
Cheerio.